Introduction. Buyers and sellers look to real estate professionals to explain how ownership of personal homes and investment properties affects their income taxes. While licensees are not expected to be tax experts, the duty of skill, care, and diligence requires a basic understanding of this important subject. This unit begins by covering the deductibility of homeowner expenses such as taxes and interest. The material discusses the rules permitting the use of individual retirement accounts, IRAs for home investments, as well as the tax deductions for vacation homes and home offices. It also describes the rules for excluding taxes on the gain from the sale of a personal home. The next section of the unit deals with taxes on investment property and explains how to calculate taxable income from an investment property. The unit also covers the important issue of deducting an investment's tax losses from the investor's other income. Another section describes how to estimate the taxes due from the sale of an investment property. The last section of the unit discusses installment sales and tax-deferred exchanges. 2018 Tax Cuts and Jobs Act. Significant changes to income tax law became effective January 1st, 2018. Ordinary income tax rates were reduced across the board, with the largest cuts going to top earners. The changes will have important impacts on homeowners and real estate investors. The standard deduction was nearly doubled to $12,000 for single filers and $24,000 for married couples who file joint returns. Because of the higher standard deduction, many homeowners who formerly itemized deductions for property taxes and mortgage interest will no longer do so. This removes an important incentive for renters to buy a home for tax reasons. The state and local tax deduction is now capped at $10,000, so owners of very expensive homes will lose benefits. Owners in high tax states, such as New York, New Jersey, and California, will be especially affected by this provision. Home interest deductions for new mortgage debt is capped to a maximum loan amount of $750,000, formerly $1 million. Interest on home equity loans is no longer deductible. Long-term capital gains tax rates remain the same at 0%, 15%, and 20% depending on the ordinary income of the taxpayer. The tax rates paid by corporations were cut by 40%, from 35% of taxable income to 21%. Individuals can generally deduct 20% of their qualified business income from partnerships, S corporations, and sole proprietorships. There is a phase-out based on income level. The estates of decedents who died in 2017 had a basic exclusion from estate taxes of $5,450,000. Indexed for inflation, that exclusion was doubled to $11 million. $22 million for married couples. The top tax rate on estates is now 40%. Income tax treatment. Principal and second homes interest on personal loans is not deductible and usually has higher interest rates. In spite of this, many taxpayers make prepayments on their mortgages before paying off personal loans, a questionable financial strategy. Generally, non-deductible, higher interest loans should be paid first. The mortgage loan must be recorded, or the interest may not be deducted. Example, John and Mary wished to purchase a home. John's parents had $300,000 in several 6% bank CDs. John suggested that they lend him $100,000 so he could purchase the home, and he agreed to repay them with interest at 9%. His parents made the loan, and John made monthly payments. At the end of each year, John referred to his amortization schedule and deducted the interest portion of the payments. A random IRS audit revealed that the mortgage had not been recorded. The IRS disallowed John's $28,231 in deductions for the previous 3 years and charged a penalty plus interest. If an individual borrows more than the allowed limit on a mortgage, the interest may be deductible as investment interest. The loan proceeds, however, must be segregated and used specifically for investment purposes, rather than for personal use. The deduction is limited to investment income. Home construction mortgages interest may be deductible from the time construction begins and for 24 months following if, at completion, the home is used as a principal home or a second home. The loan amount is subject to the $1 million ceiling. Home improvement loans. These loans are treated as acquisition debt subject to the $1 million ceiling, but only for the amount of actual improvements that can be capitalized. Interest on debt incurred to repair a property is not included. Refinance loans. The owner may deduct interest as follows. If the loan is for the same amount or for less than an old loan, there is no tax effect. If the funds are used to buy, build, or improve a home, it is acquisition debt, subject to the $1 million limit. If the funds are used for any other purpose, it is home equity debt, subject to the $100,000 limit for deductibility. Other types of loans: reverse mortgage. An institution that pays a borrower monthly payments or a lump sum makes a reverse mortgage. The borrower pays principal and interest when selling the home. No deduction is allowed until interest actually is paid. Shared appreciation mortgage. An institution offering a lower fixed rate loan in addition to a share of the equity increase after, for example, 5 years makes a shared appreciation mortgage. The lender's share is added to the loan, but it is not interest. Interest the borrower pays on the increased loan is deductible. Points: 1 point equals 1% of the loan. Points are, in effect, prepaid interest. When a loan is used for the acquisition or improvement of a personal home, points are deductible in the year paid as interest if the personal residence secures the loan. Charging of points is an established business practice in the area. Amount of points doesn't exceed the typical charges for points in the area. Amount of points is based on a percentage of the loan and described on the closing statement as points, origination fee, or loan discount, and borrower pays the points directly to the lender, not to a mortgage broker. Deductibility of points. For considerations on the deductibility of points are these. Points are deductible in the year paid only if the loan is for the purchase of a principal residence. Deductions for points paid for a second home, investment property, or refinancing must be spread out over the life of the loan. Points paid are not deductible if they are higher than usual for the area. Points paid by the seller are deductible by the buyer as interest. The amount must be deducted from the home's cost basis. The seller may treat the points as a selling expense. Points paid to refinance the property are not fully deductible the year paid. Instead, they are capitalized and can be written off over the period of the loan. Amounts of points deduction is limited. Jerry is in a high tax bracket, which he expects will be substantially lower when he retires. He can get a 7.5% loan on his new property from his banker, but arranges instead to pay 32 points to reduce the interest rate to 3.5%. He deducts the points in the year paid. Because of the unusually large interest deduction, the IRS flags the return. In the subsequent audit, the IRS disallows the deduction because the amount of points exceeded the typical charges for the area. Jerry must write off the excess points over the life of the loan. Prepayment penalties. Penalties or lender levies for an early loan payoff are deductible as interest in the year paid. Delinquency penalties, however, generally are not. The IRS says that the charge compensates the lender for the extra work to be done in the collection process, rather than covering the use of the money. Other benefits. The IRA deduction for down payment. First-time home buyers can use up to $10,000 of their IRA savings for a down payment or related expenses. A first-time buyer is a person who had no ownership interest in a principal home for the previous 2 years. It also may be used for a child, grandchild, or ancestor. The income tax effects depend on which type of IRA the money comes from, traditional or wealth. Special rules. Special rules apply for tax deductions on vacation homes and for persons who deduct expenses for home offices. Vacation homes. Persons who own vacation homes as their second homes can deduct interest in property taxes up to the limits described earlier. If a property is rented for less than 15 days in a tax year, the rental income is not reported, and normal homeowner deductions for taxes and interest apply. When the unit is rented for 15 or more days, the rules change. The owner must specify the number of days of personal use and the number of days the unit is rented at fair market value. If the number of personal use days does not exceed 14, the unit is taxed as an income property. See the next section. However, if the owner or any family members use the property for more than 14 days or more than 10% of the days the home was rented, the unit is treated as a residence. Expenses can be deducted only to the extent of rental income. See vacation rentals with personal use. Vacation rentals with personal use. Sandra and Robert own a home on St. George Island. Robert is preparing the tax return. His records show 12 personal use days and 100 fair value rental days. Rental income for the year was $11,800. Expenses were $14,900, including interest, taxes, management fee, maintenance, and depreciation. Robert carefully avoided using the unit more than 14 days for tax purposes. However, his use exceeded 10% of the rental days. 12% 100 equals 12%, so it is treated as a residence anyway. He may deduct only $11,800 of his expenses, the amount of his rental income. Office and home. Persons who operate businesses from their homes often deduct expenses such as insurance, repairs, utilities, and depreciation. Simply doing business from home is not enough to qualify for the deductions. However, the IRS has set strict requirements concerning home office deductions to prevent abuses. See, can you deduct the business use of your home expenses? Taxpayers must prove that they use the home area for which a deduction is claimed exclusively and on a regular basis, either as a place of business to meet or deal with customers in the normal course of their business, or their principal place of business, meaning that taxpayers spend most working hours there and derive most of the business income from the home office. For example, a plumber's home office deduction was disallowed because he spent most of his time at customers' homes repairing their plumbing. A home office meets the principal place of business rule if the taxpayer uses it to conduct administrative work and no other fixed location exists where the taxpayer carries out administrative work. A specific area must be exclusively office space, with no personal activities in that space. If the kids do their homework in the office after school, the taxpayer forfeits the right to the deduction. If the home office meets all tests, the taxpayer may deduct a pro rata share of the home expenses, but never more than the business income. Employees of a company or real estate sales associates usually don't qualify for home office deductions if they have office space at work. Also, a sales associate's income is attributable to outside selling activities rather than the activities in the home office. Another consideration is the need for the broker to register the office as a branch location with the DBPR if customers visit the home. Tax incentives for low-income housing. Low-income housing has long been a priority for government policymakers, who offer developers tax credits to encourage them to build or rehabilitate low-income housing. The requirements to qualify are complex and the availabilities of credits are limited, but those developers who do their homework can increase their investment return substantially. A tax credit is a 100% direct reduction in taxes. It is about 3 times better than a tax deduction, as the following example shows. Example: a person who earns $100,000 in taxable income pays taxes on the last dollars of income at 28%. A $10,000 tax deduction would save $2,800 in taxes. $10,000 x 28%. A tax credit of $10,000 would save the full $10,000. The low-income housing tax credit program works as follows. An owner-developer who builds or rehabilitates low-income housing is entitled to a 9% credit of the qualified cost each year for 10 years. The costs must exceed $2,000 per unit. If the construction is subsidized by the federal government or tax-exempt bonds, the credit is reduced to 4% per year. If an existing property that has not been used as low-income housing for the previous 10 years is converted to low-income housing, the credit is 4% per year. Target requirement: 1. At least 20% of the units must be occupied by tenants with incomes of 50% or less of the area's median income. Or 2. At least 40% of the units must be occupied by tenants with incomes of 60% or less of the area's median income. The incomes are adjusted for family size. These credits offset taxes on both passive and active income. However, if the taxpayer's rental properties show a taxable loss, the credits are limited. In effect, the combination of credits and tax losses cannot result in more than the equivalent of a $25,000 loss. The total tax credit available is calculated based on a state's population. The credit is $1.25 per resident. In Florida, that limits the total credits to around $17 million. Sale of principal residence. Income tax rules allow a single filer to exclude tax on up to $250,000 of the gain from the sale of the filer's principal residence. Married couples filing jointly may exclude up to $500,000. See excluding gain on sale of a home. Excluding gain on sale of a home. Harold and Deidre have owned their Orlando residence for 18 years. Harold just turned 55 and has retired. Their dream is to travel to the Far East and then explore the United States. Broker Jim prepares a CMA on their property, indicating that, after expenses, they may have a $475,000 gain. Harold fears that the taxes on the sale will be more than his cash proceeds. Jim explains that the law allows them to avoid paying any taxes on up to $500,000 of any gain. That savings is enough for you to take a long vacation to Australia and Hong Kong later, he says. Exclusion of gain on sale or exchange of principal residence. To exclude gain, a taxpayer must both own and use the home as a principal residence for 2 of the 5 years before the sale. The ownership and use periods need not be continuous. The 2 years may consist of 24 full months or 730 days. Short absences, such as for a summer vacation, count as periods of use, but longer breaks, such as a 1-year sabbatical, do not. The taxpayer also must not have excluded gain on another home sold during the 2 years before the current sale. Reporting requirements to IRS. The Internal Revenue Service has established temporary regulations on the subject of excluding gain, but with a reduced maximum amount. When the seller does not satisfy one of the time rules, the tax law provides an exception to the 2-year rules for use, ownership, and claimed exclusion when the primary reason for the sale is health, change in place of employment, or to the extent provided in IRS regulations. Unforeseen circumstances. Taxpayers may establish by the facts and circumstances of their situations that their home sales were for one of these reasons. To make things easier, the IRS has identified various safe harbors that will automatically establish that the sale is for one of these reasons. Home sale related to change in employment. The temporary regulations provide that a home sale will be considered related to a change in employment if a qualified person's new place of work is at least 50 miles farther from the old home than the old workplace was from that home. This is the same distance rule that applies for the moving expense deduction. The employment change must occur during the taxpayer's ownership and use of the home as a residence. A qualified person is the taxpayer's spouse, a co-owner of the home, or a member of the taxpayer's household. Home sale related to health. A sale will be considered because of health if the primary reason is related to a disease, illness, or injury of a qualified person. If a physician recommends a change in residence for health reasons, that will suffice. In addition to the persons listed above, a person qualified for health reasons includes certain close relatives, so that sales related to caring for sick family members will qualify. Home sale based on unforeseen circumstances. A sale will be considered as occurring primarily because of unforeseen circumstances if any of these events occur during the taxpayer's period of use and ownership of the residence. Death, divorce, or legal separation. Becoming eligible for unemployment compensation. A change in employment that leaves the taxpayer unable to pay the mortgage or reasonable basic living expenses. Multiple births resulting from the same pregnancy. Damage to the residence resulting from a natural or man-made disaster or an act of war or terrorism. Condemnation, seizure, or other involuntary conversion of the property. Any of the first 5 situations listed must involve the taxpayer, spouse, co-owner, or a member of the taxpayer's household to qualify. The regulations also give the IRS commissioner the discretion to determine other circumstances as unforeseen. For qualifying sellers, the maximum exclusion amount is limited to the percentage of the 2 years that the person fulfilled the requirements. Thus, a qualifying seller who owns and occupies a home for 1 year, half of 2 years, and who has not excluded gain on another home in the time, may exclude half the regular maximum amount, or up to $125,000 of gain, $250,000 for most joint returns. The proportion may be figured in days or months. A taxpayer may not deduct a loss on the sale of a personal home. Real estate investment operations accounting methods. Net operating income, before-tax cash flow, and after-tax cash flow. Appraisers are interested primarily in an investment property's net operating income. This was discussed in detail in Unit 7. Financial institutions want assurance that an investment can pay the annual debt service and leave enough before-tax cash flow to provide a cushion. Although the investor is interested in these 2 amounts, probably the most important total to the investor in evaluating the real return is the financial statement's bottom line, known as after-tax cash flow. This is the result of either subtracting income taxes paid from before-tax cash flows or adding income tax savings that can be used as a shelter against other income. The complete financial statement for an income property is shown in Income Property Financial Statement. Determination of net taxable income. Calculating the taxable income from operations starts at net operating income. Then the reserve for replacements is added, and interest and depreciation for the year are deducted, as is amortization of loan costs. See Calculating taxable income for investment property. Calculating taxable income for investment property. Reserve for replacements. The reserve for replacements spreads large, infrequent expenses such as roof replacement equally among each year's financial statements. Appraisers and investors use it to stabilize the net operating income necessary to capitalize value. The reserve is similar to depreciation in that it provides for the wearing out of different components of the property. Congress has mandated arbitrary recovery periods for the improvements and allows a tax deduction for depreciation. The reserve is not tax deductible. It must be added back to the net operating income if it has been deducted in the operating expenses. Interest paid on income property is tax deductible. Principal payments are not. A taxpayer can determine interest paid by referring to the lender's Form 1099, an amortization schedule, or by using a financial calculator. Interest paid during construction of investment real estate is not deductible in the year it is paid. It is capitalized and becomes part of the building's cost. Depreciation. Real estate income. Properties that have definite lifespans, such as buildings, can be depreciated. Land, which has an indeterminate lifespan, cannot be depreciated. The cost of an investment property must be allocated between land and building using a defensible ratio. See figure. Janice's office building. Allocating acquisition costs to building and land. Many taxpayers refer to an appraisal of the property, while others use the tax appraiser's building ratio. Once the building ratio has been determined, the ratio is applied not only to the purchase price but also to the property's acquisition costs, such as survey, title insurance, and appraisal expenses. Janice's office building. Allocating acquisition costs to building and land. Janice buys an office building for $400,000. She pays $2,000 for an appraisal, $700 for a survey, $9,000 for her broker's commission, and $1,800 for title insurance. The appraisal indicated that the total property value is $400,000. The building's value is $320,000, and land is $80,000. What is the depreciable basis of Janice's office building? Methods of calculating depreciation. Depreciation, also called cost recovery, is based on an arbitrary recovery period. Residential income property, with the dwelling units producing at least 80% of the income, has a straight-line recovery period of 27.5 years. Non-residential income property has a recovery period of 39 years. Therefore, the depreciation for Janice's office building and Janice's office building, calculating taxable income for an investment property would be $8,482.05 per year, $330,800 per 39 years. Janice's office building. Calculating taxable income for an investment property. Janice's office building shows $40,000 in net income during the second year of operation. A $3,000 reserve for replacement is included in the operating expenses. Depreciation is $8,482.05. Interest for the year was $23,858.07. Janice's taxable income is calculated as follows. Depreciation is a tax deduction that does not require a cash payment. Principal payments are cash payments that are not deductible. A quick way to assess the tax sheltering aspects of an income property's cash flow is to measure the depreciation exceeding the principal payments on the mortgage. This excess is the amount of cash flow that is sheltered. In many situations, personal property is part of the purchase price, allowing a separate allocation to items such as furniture and appliances. Most real estate-related personal property has a 7-year recovery period. Because of the shorter cost recovery period, personal property qualifies for bigger depreciation deductions. The depreciation deduction for a property's first and last years of ownership is based on the mid-month convention. That is, when the property is acquired or sold, whatever the date. Cost recovery is calculated from the middle of the month. For example, assume an investor, a calendar year taxpayer, bought his property on March 1st. While he would like to take depreciation for 10 full months of the year, the IRS allows depreciation for only half of March, giving him 9.5 of 12 months. Losses. While most investment properties show some taxable income, occasionally a property has negative taxable income, a tax loss. The investor can use the loss to reduce the taxable, not the non-passive, income of other real estate investment properties the investor owns. Taxes from operations. Taxable income from rental properties may be offset by losses from the investor's other rental properties. The amount remaining is taxed at the taxpayer's income tax rate. Passive versus non-passive income. Rental income and losses are automatically treated as passive income unless they are earned or incurred by a person who makes a living in real estate. If a net loss results from all passive activities, the loss generally cannot offset non-passive income, such as wages, salaries, dividends, or interest. One exemption from the rule covers owners who participate in their property's management decisions. An active participant whose adjusted gross income is less than $100,000 may deduct up to $25,000 of the passive losses from non-passive income, such as salaries. The deduction, reduced by 50 cents for each additional dollar earned, is suspended when adjusted gross income reaches $150,000. Limited partners are not active participants. Therefore, they do not qualify for the allowance. If sustained losses are greater than what can be deducted currently from other passive income, the investor may use the losses to offset passive income in the future. The investor also may use the losses to reduce the gain when the property is sold. Full-time real estate professionals, such as builders, developers, investors, property managers, real estate brokers, and sales associates, may deduct the entire operating loss from any other income, including non-passive income. To deduct losses in full, a real estate professional must devote more than 50% to personal services and at least 750 hours to all real property businesses in which the professional participates materially. With a married couple, only one spouse must meet the requirement. Tax classifications of investment for tax purposes. 4 principal classifications of real property exist: personal residence, for sale to customers, trade or business, and investment. Personal residence. Taxes on personal homes were discussed at the beginning of this unit. In summary, qualified interest and taxes are deductible, and all or part of the gain on the sale of a home may be excluded from taxation. For sale to customers. When owners of real estate hold their properties as inventories, such as home builders or subdivision developers, they are classified as dealers. Dealers in real estate may not deduct depreciation, may not defer recognition of gain, either by exchange or by the installment plan, and may not have gain taxed at lower capital gains rates. Trade or business. Real estate held for use in a taxpayer's trade or a business, such as an office building, a manufacturing plant, or a retail store, receives the most favorable tax treatment. All of the investment's operating expenses are deductible, including depreciation. Capital gains may be deferred by exchange or the installment sale method. Capital losses are deductible. Investment. Real property held for investment is treated as a passive investment, which limits the use of tax losses to shelter other non-passive income. Taxpayers may deduct depreciation at their own tax rate. At the time of sale, the taxpayer must pay taxes on all depreciation taken at the 25% rate, but this usually is lower than the rate at which the depreciation was deducted originally. Capital gains are taxed at lower rates than ordinary income. Up to $3,000 on net capital losses may be deducted annually, with the balance carried forward to future years until it is depleted. Tax status of investor. The way a property is owned affects how it is taxed. For example, a corporation pays taxes on its income at corporate income tax rates. When shareholders receive their returns from the corporation as dividends, they must pay taxes on the dividends. If the business had been organized as a partnership, a real estate investment trust, an S corporation, a tenant in common, or an individual, taxes are paid only once. At the individual level, Janice's office building. Calculating taxable income for an investment property shows how the taxable income is calculated for Janice's office building. Janice's office building. Calculating after-tax cash flow for an investment property. Janice's office building. Calculating after-tax cash flow for an investment property shows how the taxes are calculated from the taxable income, then deducted from before-tax cash flow to get the after-tax cash flow. Janice's office building. Calculating after-tax cash flow for an investment property. If Janice's marginal tax rate is 32%, she pays $3,411.16. $10,659.88 X.32 in income taxes for this property. This figure is subtracted from before-tax cash flow in order to show after-tax cash flow. Sale of investment real estate. Determination of gain or loss when a capital asset is sold. The investor must calculate whether the sale resulted in a gain or a loss. The investor will also have to show whether the transaction was a long-term or short-term gain or loss. Janice's office building. Calculating gain or loss for an investment property as shown on Schedule D provides an example of calculating gain or loss. Janice's office building. Calculating gain or loss for an investment property as shown on Schedule D. After 5 years, Janice sells her building for $700,000. Selling costs were $38,000. She made capital improvements totaling $75,000. She has taken depreciation of $42,410.26 during her years of ownership. Based on this information, Janice calculates gain as follows. Taxation of gain or loss when a capital asset, such as real property, is sold. The owner may have a capital gain or a capital loss. The tax due on the gain depends on the length of time the property was held. There are 2 types of capital gains treatments, short-term and long-term. An owner has short-term gain if the property has been held for 1 year or less. Short-term gain is taxable at the taxpayer's rate. An owner has long-term gain if the property has been held for more than 1 year. The maximum tax rate on long-term gains is 15% for taxpayers earning less than $25,800, $79,000 for joint filers, and 20% for taxpayers making more than those amounts. High earners must pay an additional 3.8% net investment income tax. If the taxpayer's overall ordinary tax rate is in the 10% or 15% tax brackets, then the taxpayer's capital gains rate is 0. The portion of gain that comes from the depreciation taken during the holding period is subject to taxes at a 25% rate. See Janice's office building. Calculating taxes on gain from sale of an investment property. Janice's office building. Calculating taxes on gain from sale of an investment property. Janice calculates the gain on the sale of her property to be $173,500. Because her ordinary income is less than $425,800. This gain is taxed at 15%. The depreciation is taxed at 25%. Janice calculates her taxes on the gain as follows. An investor may deduct up to $3,000 in net losses on investment real property, with the balance carried forward to future periods. For example, if Janice sells one of her properties and incurs a $7,000 loss, she may deduct $3,000 this year, $3,000 next year, and $1,000 the year after that. If, however, she has a $5,000 capital gain next year, she can offset the remaining $4,000 against that gain. After-tax reversion. Reversion from sale is another term for proceeds from the sale. The balance of Janice's mortgage is now $276,821.82. The calculation for Janice's after-tax proceeds from sale is shown in Janice's office building. Calculating the after-tax equity reversion. Proceeds from the sale. Janice's office building. Calculating the after-tax equity reversion. Proceeds from the sale. Methods of deferring taxes upon disposition. Most investors should consider the advantages in deferring or avoiding payment of taxes on the disposition of property. Two principal methods accomplish this objective: installment sales and like-kind exchanges. Installment sales. The installment sale method of reporting offers several advantages. If property is sold on the installment sale basis by a taxpayer in a high tax bracket who is close to retirement, the retiree may be able to pay taxes on the gain at a lower tax rate in later years. This is particularly effective if the gain on sale is a short-term gain. The installment sale method allows for better planning, because the entire amount to be received is spread out over many years rather than coming in one lump sum. Interest rates on owner financing often are more attractive than other investments of comparable risk. In an installment sale of depreciable property, the investor reports any depreciation recapture as income in the year of sale. The recaptured depreciation is deducted from the gross profit before the investor calculates the gross profit percentage. If an installment mortgage on a sale of property for more than $150,000 is pledged as security for a loan, the net loan proceeds are treated as a payment on the installment obligation and are immediately taxable. Installment sale reporting is automatic when owner financing is involved, but the seller may elect to pay taxes on the entire gain in the year of sale. Losses may not be deferred under the installment sale method. An example of installment basis reporting is shown in Installment Sale Reporting Example. Installment Sale Reporting Example. Installment Sale Reporting Example. In 1980, Harry purchased a tract containing 150 acres for $700,000. This year, he agrees to sell it to an investor for $1.5 million with a 20% down payment. Harry will hold a 15-year mortgage at 10%. His selling costs are $104,000. To calculate how much of each principal payment is taxable as gain, Harry takes the following steps. 46.4% of each payment other than interest represents gain on the sale and is taxable. The taxable portion of the $300,000 down payment, 20%, is $139,200. 46.4% of $300,000. Like-kind exchanges. In a like-kind exchange, real estate held for investment or for productive use in a trade or business may be exchanged for other real estate of the same character, called like-kind property. Realized gain on the disposition may be deferred until the owner disposes of the new property. Like-kind property that may be exchanged includes any of these: residential income producing property, commercial property, industrial property, vacant land held for investment. except dealer property, leaseholds for 30 years or more. Hotels and motels tax-deferred exchanges of real property are not available for dealers or for personal homes. A two-party like-kind property exchange does not qualify if the parties are related, if either party sells the property voluntarily within 2 years of the exchange, or if one property is outside the United States. While the capital gains rates are very attractive for investors, the like-kind exchange is the method of choice to dispose of investment property. It allows the investor to acquire more or larger properties without using any of the capital to pay taxes. See example of a tax-deferred exchange for an example of a tax-deferred exchange. Example of a tax-deferred exchange. Wilson has a piece of property that Jones wants, but Wilson wants to do a tax-deferred exchange. Jones does not have a property that Wilson wants, but agrees that he will buy a property selected by Wilson, then transfer it to him to complete the exchange. Wilson finds a property he likes. Jones buys it, then transfers it to Wilson. If Jones does not complete the acquisition and transfer to Wilson, Jones must pay Wilson the price in cash. Often, one party must pay the other cash or personal property to balance the equities. This boot is taxable to the party receiving it. In other cases, the mortgage on the property given up is more than the mortgage on the property received. This net mortgage relief also is taxable boot. If neither party receives boot, neither needs to recognize any gain or pay any taxes on the disposition. A direct barter of properties is difficult. For example, John may have property he wants to dispose of and may find another property he wants instead. The problem is that owner may not want John's property. Because of this problem, the three-way or multi-party exchange was a technique designed to solve the difficulties of a two-way swap. Unfortunately, these exchanges have lots of problems also. When one or more of the parties fail to cooperate with the exchange, or one of the needed transactions fails, the entire exchange fails. Multi-party exchanges, at best, are difficult and risky. The Section 1031 exchange simplifies the process. Section 1031 exchange. Section 1031 of the tax code allows traders to set up an exchange for properties not yet available. The replacement property must be identified within 45 days of the initial transfer, and title to the replacement property must be transferred within 180 days or before the tax return due date, including extensions, whichever is sooner. The exchange is handled by a qualified intermediary, who simplifies the transaction. See example of a tax-deferred exchange using a qualified intermediary. A qualified intermediary is an unrelated party who, for a fee, facilitates a deferred exchange. The intermediary may not be an employee of an owner, or a person who has acted as an owner's professional advisor, such as an attorney, an accountant, an investment broker, or a real estate agent. While some qualified intermediaries take title to the replacement property, then transfer it to the owner, this arrangement probably is not as good as having direct deeds from owner to buyer. First, Florida's documentary stamp tax can be a significant expense in a transaction, and paying it twice serves no purpose. Second, if the intermediary were to have any judgments or other liens recorded against him, any properties acquired, even if held for 5 minutes before the transfer out, would be encumbered. Third, environmental laws may impose toxic waste cleanup liability on anyone in the chain of title, which includes the qualified intermediary. Example of a tax-deferred exchange using a qualified intermediary. Wilson has a piece of property and wants to arrange a tax-deferred exchange. He lists the property with his broker and gets an offer from Jones, which he accepts. Wilson contacts a qualified intermediary, who agrees to complete all the paperwork for a fee. Wilson assigns his contract to the intermediary. The intermediary suggests that Wilson start looking for another property immediately. Wilson's broker finds a listed property and negotiates a contract. Wilson assigns his purchase contract to the intermediary. The intermediary ensures that the necessary paperwork is completed and attends the closings. The two principal tax deductions available to homeowners are interest and property taxes. Homeowners may deduct all or part of the interest they paid during the year for up to 2 homes. Up to $1 million in all debt qualifies for a home mortgage interest deduction. For mortgages taken out after January 1st, 2018, the limit is $750,000. When a loan is used for the acquisition or improvement of a personal home, points are generally deductible in the year paid as interest, with several exceptions. A homebuyer who has not owned a residence for the previous 2 years can use up to $10,000 of an IRA to make the down payment and pay acquisition costs on her home. Expenses for a vacation home. If the owner uses the home more than 14 days per year or the home is rented out more than 10% of the time, are deductible only to the extent of rental income. A person who wishes to deduct expenses for an in-home office must meet strict guidelines. A homeowner who occupies a residence for 2 years may exclude up to $250,000. $500,000 for married couples filing jointly. On the gain from the home sale, an investor may deduct interest and depreciation from a rental property's net operating income. Reserves for replacement are not deductible for tax purposes. The first step in calculating depreciation is to allocate acquisition costs between land and improvements. Only improvements may be depreciated. Residential income property may be depreciated straight line using a 27.5-year life. Non-residential improvements may be depreciated straight line using a 39-year life. If an investment property shows an operating loss, the investor's ability to deduct the loss from the non-passive income depends on the investor's situation. If the investor earns more than $150,000 in income, she may not deduct any of the loss but can use it in future years against passive income or at the time of sale. An active participant earning less than $100,000 may deduct up to $25,000 of the loss from other non-passive income. A real estate professional may deduct the entire loss from other non-passive income. Long-term gains on the sale of investment property have a maximum 15% tax rate for taxpayers earning less than $25,800, $79,000 for joint filers, and 20% for taxpayers making more than those amounts. Any depreciation taken during the holding period is recaptured and taxed at 25%. If all sales, when taken together, show a loss, a maximum of $3,000 in net losses is deductible annually. An installment sale allows the investor to pay taxes on the gain as the payments are received, rather than paying in the year of sale. A like-kind exchange allows the investor to defer paying taxes on the gain until the new property is sold. Viewed as taxable property received that is not like-kind.